Hi everyone, Neža here, and welcome to Stock Break, where I give an in-depth analysis on public companies in under 5 minutes, breaking down their fundamentals and potential valuation. Let's dive in. Today, we will talk about Nike. Just a quick reminder before we start, this presentation is for educational purposes only, and it should not be taken as investment advice or recommendation to buy or sell any financial instruments. Now we can dive in and take a look at their official website. In short, Nike's global sportswear giant that is designing, manufacturing, and selling athletic footwear, apparel, and equipment. They have deals with many well-known athletes, and they also own brands like Jordan and Converse. The company was founded in 1970s and went public in 1980s. Over the years, their popularity grew, and in 2013, it joined Dow Jones Index. The stock reached an all-time high in 2021 when it was trading above $170 per share, and this surge was driven by strong digital sales, effective direct-to-customer strategy, and popular sneakers, which boosted profit and revenue despite some supply chain issues. However, in the following year, the stock dropped nearly 30% as supply chain issues persisted and they caused rising costs and also excess inventory. If we take a look at this year's performance, the stock is down by about 22%. It dropped by nearly 20% after they released a disappointing earnings report in June, but since then it rose by 12% as they got some boost from improved spending trends and also from the news that Bill Ackman hedge fund started a new position in Nike. The recent drop after earnings release was not without a reason. Even though their annual revenue increased by 1%, their fourth quarter revenue dropped by 2% compared to the last year, and their direct revenues dropped by 8% in the fourth quarter. On the positive side, however, their wholesale revenues were up 5% in the fourth quarter. Disappointing performance from Converse and cautious outlook also affected investors' confidence, which caused the stock to drop. But when we take a look over a long term, Nike has shown a steady growth with annual increases in both revenue and net income by about 6% over the last decade. Nike revenue growth is primarily driven by strong footwear segment, which represents about 70% of their all operating revenue. Much smaller part of the revenue represent other segments like apparel, equipment, and other brands like Converse. Nevertheless, Nike still has a diversified product portfolio, which helped them to maintain a robust revenue growth despite some industry challenges. Another important factor to consider are channels that Nike uses to sell their products. That includes direct-to-customer sales through Nike-owned retail stores and digital platforms, and wholesale sales to various third-party retail stores. Here on this graph, we can see that Nike direct-to-customer revenue has been rising recently, and that's because Nike has been focusing more on this approach, and they even decided to cut half of their wholesale partnerships. But in the end, this approach led to market share losses and inventory issues, so now they're trying to shift back and enhance wholesale partnerships. As I mentioned inventory, let's check inventory turnover for Nike. This ratio basically measures how often inventory is sold and replaced. So high ratio may indicate strong sales and efficiency, and on the other side, low ratio may suggest overstocking and weak demand. Over the past decade, it has generally declined, with a sharp decline during pandemic, but recently we saw some improvement, which might be indicating better management decisions and stronger sales. For the last part of this presentation, we're going to take a look at potential valuation. After peaking over $170 per share in 2021, Nike stock is back to pre-pandemic levels due to weaker sales in China, softness in key product areas, and broader economic uncertainty. While Nike has been the leader in the industry for a long time, the recent challenges highlight the need for constant product innovation and also managing balance in distribution strategies depending on market situation. Because during pandemic, Nike leaned heavily on digital sales, but now with consumer behavior normalizing, they need to rebuild these relationships they had with retail partners, and that might be a bit challenging. Despite these challenges, Nike's strong brand and financial management provide a solid base for future. They have a consistent track record of generating free cash flow. They have been rising their dividends for 22 consecutive years, and additionally, they spent over $4 billion on share buybacks in the last year alone. While risks like rising competition and market uncertainty remain, Nike's solid foundation could enable potential turnaround in the future. With a price-to-earnings ratio of 22, which is near its lowest in a decade, Nike is seen as significantly undervalued by Guru Focus. I hope you enjoyed this episode. Don't forget to like, share, and subscribe to our channel if you like the content, and let me know in the comment which company would you like to see next.